How a retiree can enjoy a 10% payout while only earning 8% and not deplete the principal. In this episode, I'm going to teach you how an insurance company, if they're only crediting you 8% on your IUL, and sometimes people don't even understand how an insurance company can afford to credit you 8% when they're only earning 5% on their general account portfolio. I have another episode that explains that, but most of our clients are being credited at least 8% on their IUL. And if that's all you earn, you could actually pull out 10% a year. On $1 million in an IUL, you could generate $100,000 a year of income. A 10% payout on $1 million is $100,000 a year without depleting the $1 million nest egg, even if they're only crediting you 8%. So get ready. When you understand this, you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their true, or what I call authentic, wealth. And my favorite financial vehicle, without question, is a property structured max funded indexed universal life, IUL. Now, in another episode, I show how an insurance company, if they're only earning 5% on their general account portfolio assets, the billions and trillions they have invested in AAA and AA bonds and mortgages on skyscrapers and shopping malls, how can they afford to pay you 8% average if they're only earning 5%? If you don't understand that, you better watch that episode. But my next question is this: if they're crediting you 8% on $1 million in an IUL, that's 80 grand. If they're crediting you 8%, how can you pull out 100 grand or 10% a year and not deplete your million if you're only being credited 8? And if you don't understand this, you're missing out. So please stay with me here, because you first of all need to understand how money works. Okay. So this is how money really works. There's 4 things you can basically do with money. Okay. You can spend it, you can lend it, you can own with it, or you can give it away. Now, if you watch very many of my episodes, I own and loan on the same assets. I sort of double dip. But when you have your money in a bank or a credit union or an insurance company, it's in a lended position. You're loaning your money to that institution. Are they just benevolent, paying you interest? They put your money in a vault? No. What are they doing with your money? They're turning around and loaning it back out again, or investing. Banks take 30 to 40% of their tier 1 assets and they put it into insurance companies that are ranked about 5 or 6 notches higher in safety, and they earn 5 times, 500% more. They pay you 1%, they earn 5%. Okay. Every 10,000 they pay in interest, they make 50,000. How much more is 50,000 than 10,000? It's 500% more. Okay. So here's a bank. They'll gladly pay you on a CD maybe 4.5% interest. Why? Because they're going to take your money that you put in that CD, they're going to turn around and loan it, maybe back to you, at 7.5%, 3% higher. Now, they need to cover their overhead of 1 or 2%. They might only net 1% on that. And some, illiterate financial advisors go, "You'll do all that for 1%? Yeah, they make billions. Okay. Now, folks, let me make sure you understand the math. Banks in 2008 were paying less than 1%. Okay. So in 2008, every $1 million of OPM, other people's money that were sitting in banks in America, they were paying at 1% interest, $10,000 a year in interest to borrow that money. Okay. And now, if they stopped paying that interest, they would wither up and die. Okay. A bank or credit union's greatest asset is its liabilities. Now, why did they do that? When the federal government asked the 5 major banks in America in 2008 to disclose where they had their tier 1 assets for liquidity and safety, guess where it was? In insurance companies. Okay. BOLI, bank-owned life insurance, earning 5. Okay. How much more is 5 than 1? Don't say 4. It's 500%. Okay. Would you hire an employee for 10 grand that made you an extra 50 grand? That's what the banks were doing. They were making 500%. Now, I'm going to show you that I was also earning 500%. Okay. But, over the last 40 years or so, on every $1 million, let's say, of real estate that I might own, if I borrow $1 million on real estate, if I paid an average of 6%, but if that's tax deductible, which under Section 163 of the code, it would behoove you to do it right so you can tax deduct that interest. I write that off on my tax return. In a 33% bracket, I'm saving a third of that 60 or 20 grand in tax savings. This is real money. This is not paper money. So the net cost of a 6% tax deductible mortgage is only 4. You with me? So it's costing me $40,000 net. If I have that million that I separated in an IUL policy, and you watch my videos on how predictable it is to earn at least 8%, how much more is 8 than 4? Don't say 4. It's 100% more, okay? Would you hire an employee for 40 grand if that employee made you 80 grand? Would you buy a widget machine for 40 grand that made you an extra 80 grand? I'd do that all day long. It doesn't behoove you to hurry and fire the employee to save money because you would stop earning money. Does that make sense? Okay. Now, I told you back in that low interest environment in 2008, interest rates were low. If you had good credit, I could borrow at 3% tax deductible interest. On $1 million, that would be $30,000 a year. I write it off, and I get to save $10,000 in tax by having that write off, and so I'm netting 2%. So it was costing me $20,000 for every $1 million, and I was making 10% by rebalancing my portfolio annually in my IUL. How much more is 10 than 2? 500%. The banks were making 500. I was making 500. We were both happy. Were you? Now, folks, I had a client back then that had several rental properties, duplexes. And when he finally understood that it was not smart taking his positive cash flow on his rental properties and paying it in extra principal payments against the mortgages to get them paid off, it was actually costing him money. He went out and refinanced several of these rental properties for $1 million, and he borrowed at 4.5% tax deductible interest in a 33% bracket. It didn't cost him $45, it only cost him $30 because he's getting $15,000 back in real money. And on his IUL, where he had these millions of dollars, he was earning 9. How much more is 9 than 3? 300%, okay? Now, if you understand what I just said, if his real estate rental properties were vacant, if they got burned down in a fire, if they got destroyed in a tornado or a flood, he would still be earning 300% even though his rental is vacant. Are you getting it? Okay. Now, this is what savvy real estate investors do. Let's get back to how an insurance company can afford to have you take out 10% a year out of your IUL. And if you're only earning 8%, you will not be depleting it because it's the principle I'm talking about here. So we call a property structure max-funded IUL a L.A.S.E.R bank. And many business owners that are savvy use this as a working capital account. If they need $1 million out of their IUL for a business opportunity to buy a piece of real estate or whatever, they can go withdraw the $1 million out of their policy, but now it's no longer in there, earning interest. So they don't do that. They leave the money in the insurance company and they borrow $1 million from the insurance company. The insurance company will loan them $1 million without even qualifying for the loan because they have $1 million of their money as collateral. So you can borrow that money at 2% and they'll credit you 2% on the collateral you left there. That's called a zero wash or zero cost loan. It doesn't cost you anything, but it's tax-free, but you're able to use your money at a zero cost. But most savvy business owners, they don't do that. They use an alternate or index loan. And so they might say, you can charge me 5%. They don't have to write out a check for that $50,000 that year on the $1 million because it's automatically deducted out of what they're earning or what's in the policy. Most of these people are earning 10% by rebalancing. How much more is 10 than 5? Double. It's 100% more. That's called arbitrage. So let me connect the dots on how you can take out more money. If I had $1 million and if I'm borrowing from the insurance company $100,000 a year of income, okay, or $1 million, that's 50,000. But if I only earn 7, and that's pretty much a no-brainer, how much more is 7 than 5? It's 2% or $20,000 more money. Okay? Now, what does this mean? If I'm using this for retirement income, I can get a 10% payout for every $1 million I have in cash value on the IUL policy. I could, if I'm earning 8%, I can withdraw 80 grand without depleting principal. Okay? But I can actually take out 100,000 a year and not deplete principal. How can I get a 2% higher payout? Because of what I just showed you. If I borrow, if I borrow 100,000 a year and they charge me 5 and I keep earning 7, just 2% higher, I can take out 20,000 more than 80,000 or 100,000 a year and not deplete principal because I'm earning 2% higher than what I'm being charged to borrow the money, which is tax-free. And you need to see this in a full illustration to see how powerful it is. You could retire at age 65, have $1 million in there, and pull out 100 grand a year for 30, 40 years and not deplete your million, even if you're only being credited 8%. So if you want to learn more, I strongly recommend that you claim a copy of our most recent best-selling book, The L.A.S.E.R Fund. This has been flying off of our warehouse shelves. You can pick it up on Amazon for $20 plus shipping and handling. And if you do that, thank you. But I'll gift you a copy for free. You simply go to laserfund.com or click on the link below, and you contribute a nominal amount toward the shipping and handling. I'll cover the rest of that, and I'll pay for the book. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's formats for your investment. You can even schedule an appointment with an IUL professional that I oversee so that you can see how a properly structured max-funded IUL works correctly in your particular set of circumstances. Don't make the mistake of going to some IUL agent that doesn't know what they're doing, okay? You can even schedule to attend a free educational webinar that we teach every single week. No charge, no obligation. But I want you to read and study the book and also talk to a professional. Now, if you are a left brain learner, this is the side you read because it has charts and graphs and explanations. But if you're a right brain learner, you learn more by stories. You simply flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. So take ownership of your brighter future. Learn how to accumulate money tax-free and generate a 10% payout and not deplete your nest egg, even if it's only being credited 8%.